5 seconds to the open. You ready?
Who wants to get this thing started right about now?
Welcome to Follow the Money Weekly with your host, Jerry Robinson.
Welcome.
Not just some guru.
Oh, really?
Your host is an economist and a best-selling author.
What an interesting news item. I'd better write that down.
And just someone who likes to make money and help you to make money. Welcome to Follow the Money Weekly. And here he is, Jerry Robinson.
Friends, welcome to the only radio broadcast dedicated to bringing you more truth packed into 1 hour than the mainstream media gives you all week long. You have found it. You're listening to Follow the Money Weekly Radio on the web at www.ftmdaily.com. That's followthemoneydaily.com. So glad that you're joining us this Saturday morning. Got a whole lot to talk about. Want to get you up to speed on what's been happening in the stock market, what's been happening in the economy. We're going to be joined by Tom Cloud in a little bit. He'll be here with a brief update on gold and silver and palladium and platinum. Also be joined by Jay Peroni, as always, with his investing idea of the week. This week, he'll be sharing 2 of the best investment ideas that he has for the long term. So I think you'll really enjoy that. Plus, John Burrs will be here to talk about what to do if you are trying to save for retirement, but also needing to save money for your children's college education. Well, what a kind of quandary that is. So he'll be discussing that as well. Plus, I'm joined this week by my lovely wife, Jennifer. Great to have you today.
It's great to be here this Saturday morning, Jerry. And what a week in stocks.
Yeah, it's been really interesting. The U.S. stock market continued a historic rally this week. And as of Thursday, the close of business on Thursday, we had seen 10 consecutive days of rallying in the Dow. The S&P 500 is at a near all-time high. The Dow is at an all-time high. And as I explained in a recent commentary, this rally is really made possible by the massive infusions of cash that have been flooding our economies thanks to the Federal Reserve, to the central banks of Japan, also to the Central Bank of England, and also in Europe. So we've had numerous rounds of quantitative easing here domestically, and I expect U.S. stocks to continue their QE-fueled ascent. But they will inevitably be confronted by the realities of growing inflation. Now, the federal government continues to push its doctor numbers. In fact, the latest numbers that I saw on inflation were 1.6% is what they say the annual CPI rate is.
And that's I just went to the grocery store yesterday, Jerry. That is insane that the number is that low.
Yeah, and a more honest analysis shows that the U.S. inflation rate is much higher in reality. In fact, the true CPI rate is much closer to 9%, and that's if you go back and you use the 1990 measurement model that the federal government used back in the 1990s. They have so much and so greatly distorted their measurements for inflation. In fact, I'll give you an example with substitution, the way they do things. If, for example, that they are counting in their basket of goods that they're trying to track the price of inflation, let's say that a particular item becomes more expensive. What they'll do is they'll take that item out of the basket and put in an inferior product to keep that down. So, I mean, that's just one example of the substitution model that we've seen implemented that is very dishonest. It does not report accurately the actual inflation rate. And you know who that hurts the most is those on fixed incomes who are dependent upon CPI increases in their Social Security and in other types of income. It's really been a kind of a tough thing for people on fixed incomes, and I do feel for you. Now, another thing you should know about this week that happened, federal government continues its unending war on your privacy. According to a new report by the U.S. Treasury Department, the Obama administration is seeking to provide every single U.S. spy agency with a massive database containing financial data on virtually every American citizen who uses the banking system. You don't have much choice anymore. If you're part of the banking system, if you are cashing checks or you are depositing checks, I mean, your financial transactions are completely transparent to the federal government. Now, all of this sensitive data that the Obama administration is seeking to provide to all federal agencies who are involved in intelligence gathering, All of this sensitive data was already available to the Federal Bureau of Investigation, the FBI, right after the events of 9/11. Thanks to George W. Bush, he made that possible. However, now the Obama administration wants to provide full access to this vast database of all these financial transactions to all other U.S. intelligence agencies. That's the CIA, the National Security Agency, also known as the NSA. So what reason has been given by the Obama administration and by the Treasury for this implementation of providing all of your private financial transactions to these intelligence agencies? You don't know? Of course, it's terrorism. Oh, yeah. Yeah, the terrorists are out to get you. So what needs to happen is the United States federal government needs to know everything about you. They need to stick their hands down your pants when you walk into the airport. They need to see all of your financial transactions just to make sure that you're not one of them. Now, this really gets out of hand when you think about it. You know, the Treasury plan that's being put forth here is in essence saying that we, as the United States government, want to make sure that we are properly able to identify terrorist networks. We can identify elements of organized crime, and we need complete and total access to all Americans' banking transactions. And I think, those who value their privacy, I think, it's kind of obvious why this is a problem. But I have deeper concerns about this. Because, an innocent pattern of financial transactions could easily be labeled by the federal government as terrorist financing or some other criminal behavior. And that would lead to numerous false allegations of American citizens. Now, when you factor all this in with the NDAA, or the National Defense Authorization Act, the sky is the limit on what the federal government could do with this information. It could get very Orwellian very quickly. So this push for further integration at the federal government level in our post-9/11 world should be concerning to every American. Put simply, the closer the government entities become, the more data sharing that they engage in, the more abusive their power that they wield will become over the American population. The last thing we need is a more integrated, intrusive federal government. Now, speaking of intrusions, let's also talk real quickly about drones. They've been in the news this week. It's commonly known that the United States military is becoming increasingly dependent upon its use of unmanned aerial vehicles, these UAVs, also known as military drones. Now, according to U.S. Senator Lindsey Graham, senator from South Carolina, approximately 4,700 militants and civilians have been killed by American drone strikes around the world. That's the very first number we've heard out of a senator's mouth about the number or the death toll from these drones. The CIA has used these unmanned robotic aerial vehicles to attack targets in Yemen, Somalia, Pakistan, and they've also been using them for their bombing campaigns in Afghanistan. But what you may not know is that for the last decade, China has also been building its own fleet of military drones. And according to a new March 2013 report released by the 2049 Institute, the Chinese military is expanding its drone technology and capabilities at a very alarming rate. And in fact, we have the complete report on our website that you can download and take a look at. But in essence, what China is doing is it's trying to overtake the United States in the number of drones that it has available. I believe the United States has less than 700 drones at this point. And as of the middle of 2011, China had just under 300 drones. But that's all changing. And so when you take a look at the report, you'll discover that China is seeking to buy more drones, build more drones, because what they want to be able to do is use them to overwhelm U.S. naval powers in the Far East, in the South China Sea, whatever the case might be. All this is leading up to a war. There's no doubt about it in that area of the world. China is flexing its muscles. Japan is now beginning to flex its muscles. Taiwan is flexing its muscles. North Korea is flexing its muscles. And now the U.S. is saying, hey, what can we do over here? They're moving over, bringing troops and naval capabilities. So we're seeing the setup for a war over there. It's very interesting what's happening. But you can download the complete report about all of these drones in China right there on our website at ftmdaily.com.
Welcome back to Follow the Money Weekly Radio. This is Jennifer Robinson, your co-host, along with Jerry Robinson, my husband and the host. And he's also the author of Bankruptcy of Our Nation. And you can find that book on our website, ftmdaily.com. Now, I ran across a story this week. It's called Wake Up. The 4% rule no longer works for retirees. This was found at the Business Insider online. This 4% rule, which many of you who have done retirement planning or any kind of financial planning or who are in retirement have probably heard of the 4% rule, but basically it states that a retiree can usually withdraw about 4% of the value of your portfolio each year in retirement, and provided that the portfolio is allocated at least 40% in equities. And so generally this is thought to, be able to last you throughout retirement if you simply withdraw about 4% of your portfolio each year. Well, many retirement experts are now saying that this model is breaking down big time, and that one cannot rely on this 4% rule to last them throughout their retirement years because of the new interest rate environment. I received my master's degree in finance, and anybody with an upper graduate degree can tell you that most of the education you receive in a master's or PhD program is related to research tools and research techniques. And so you become well-versed in doing research and how to figure out results and interpret results and all that. So this really struck me because basically the underlying assumptions in this 4% rule that has been around since the early part of the 1990s, the assumptions are basically wrong now. And you have to adjust your models and adjust your planning for retirement as the economic and interest rate and the stock market environment changes. And so basically what the story goes on to say is that experts recommend that retirees adjust their withdrawal rate to about 2.8% per year. So instead of withdrawing 4% per year, Jerry, the experts are now recommending about under 3%. That's a drastic change for somebody who's withdrawing, maybe $40,000 a year, and they might have to go down to under $30,000 a year to make it through retirement. That's a big change. And so what are some of the alternatives to drastically dropping your withdrawal rate? Well, there's a couple of things, and you can choose to work longer. That's an option, which is probably not a very popular option. You can invest your portfolio a bit more aggressively, increase your rate of return. Although for people in retirement, many of those individuals don't want to increase their risk at all. Their main goal is to protect that principal. And then the third option is to learn to live on less. If you were withdrawing $40,000 and now you can learn to live on $30,000.
I'd say that the fourth option, for many people would be to do what the smartest guys in the room do, like Ben Bernanke, and just put your money in annuities. I mean, the annuity is going to pay you a guaranteed fixed income for life. And in many cases, you can actually have an inflation rider put on there, so it'll go up with inflation, and not the CPI, but actually the CPIU, which is, not as accurate as the real thing, but it's a lot better than the CPI. So, and I think annuities, this really builds the case for using annuities in retirement. I've often compared annuities. I heard it once told me one time by one of my mentors. He said, an annuity, really all it is it's like putting rails on the side of a bridge when you're driving over a bridge. So let's say you're going 90 miles an hour and you're going across a bridge and there are no guardrails. Well, you're going to go a little slower, aren't you? 90 miles an hour might scare the daylights out of you going across a bridge with no rails. However, if the rails go up, Doesn't that give you a permission slip to go quicker? Well, that's exactly what an annuity really does, is it puts guardrails up next to the bridge so that you can go a little quicker. You can take a little more risks, in the market. And you don't have to worry about the downside because they have guarantees. So I would say the annuity in many cases is becoming very, very popular for many of the right reasons. And I wish more people would, consider them for their overall retirement mix. The mainstream press has been so negative on annuities because mutual funds, that's their direct competition. They don't want money going to the insurance companies. This is how it is.
Right. But, I will say annuities, I think, are making a comeback. We like the fixed indexed annuity. I mean, you can talk to your financial advisor about all these things, but definitely the annuity. And for those who are younger, not yet in retirement, the idea of creating multiple streams of income, as we talk about so much on this show, is just ever increasing, or the need is ever increasing to create those multiple streams of income to have for you there in retirement. Now, Jerry, I want to move on to some listener questions because we've had tons and tons pour in as I've been out the last couple of weeks. Last week, I actually woke up on Friday, the day before the show, and my voice was just completely gone. It was the weirdest thing. I wasn't sick. I didn't have any kind of illness, but just completely lost my voice. So I wasn't on the show last week, but I'm glad to be back this week. And we have 3 listener questions that I want to get to today, and we'll get to some more next week as well. But the first one comes from Sandra in Nashville, Tennessee. Sandra says, Jerry, I've heard you talk about the collapse of the dollar quite often. Do you think this collapse will herald a one world currency?
The topic of the one world currency, a single global currency, has come up over and over again throughout the last several decades. And it's something that I've never really hammered on too much here on the program because I believe we're still a ways off from actually seeing that implemented. I've been told by several people, hey, you should do a product on that, or you should talk more about the single global currency that's coming. And my belief is that we're moving towards regional currencies, something that's similar to what we see with the euro. Now, most astute economists know that the Western-dominated International Monetary Fund is the most likely candidate for having the ability to create, implement, and monitor a single global currency. That's the IMF. We've heard, from them they have the SDRs, the special drawing rights. Now, many people don't know this, but John Maynard Keynes, who's the founder of Keynesianism, was actually at the Bretton Woods Conference along with Harry Dexter White, who represented the United States at that conference. And John Maynard Keynes, his plan, his goal, his vision was to create not a dollar at the Bretton Woods Conference, not a dollar standard, but instead something he called the Bancor, BANCOR, that was actually a single global currency. And it would be stewarded and administered by the Bank of England. But let's think about this. What exactly would a single global currency look like? First, the world's most developed nations would benefit from the obliteration of currency risk in global trade. I mean, that would be the first benefit I think most people would see. This would devastate those countries who protect their competitive advantage through the clever manipulation of their currency, i.e. the United States, i.e. China. Now, with a single administrator of a single global currency and a single central bank, then in essence, interest rates would not be able to be set regionally. So if you have this total single global reserve currency that is used by all peoples, by all countries, then interest rates cannot be set individually. And that's exactly the problem that we see in Europe right now. They're trying to figure out how to get out of that mess that they have created for themselves. So they would really need a bag of new tricks to be able to pull off a single global currency. But to help you envision how a single global currency might look like, just consider Europe's adoption of the euro. I mean, one of the major concerns that nations have towards adopting a one world currency is simply the complete loss of monetary power over their own national economy. Instead, some bank in a country halfway around the world from you controls and administers your currency. They control and manage your interest rates. And so, in essence, all of the monetary policy tools would come from and issue forth from one centralized monetary authority. And that is certainly not something that many nations are willing to swallow right now. However, we could see, I fully expect to see, a shakedown of one of the major currencies that could cause a lot of people to begin looking towards another solution. But again, in answer to that question, I don't believe that a single global currency is waiting in the wings and that it's just going to be imposed upon the world. I mean, people who think about that and believe that don't understand how economics works, because you cannot simply apply that and everybody's going to go along with it because somebody says you have to. Countries will resist that at all cost. Again, look at Europe. So we have to figure out how to make the regional currencies work first before we can implement a single global currency. And therefore, that is why the euro question is so vital. So we're paying very close attention to the euro. We expect to see other regional currencies in the future, especially over, Africa. We expect to see something similar here in the Americas. And eventually, the toughest one will be in Asia. But we do expect to see these, and then from there, we would expect to see a global reserve currency that would be a single global currency. And I hope that answers the question. Jennifer?
Okay, Terrence in Camden, New Jersey. Terrence says, Jerry, it seems like all eyes are on the Vatican now. I'm interested on your take on the new Pope Francis and whether you've heard of the Malachi prophecies of the 112 popes.
Yeah, of course. I mean, we're planning on trying to get Tom Horn, who's a good friend of the show here and a good friend personally, on the program. He and his co-author, Chris Putnam, penned a book called Petrus Romanus, where they talk about this St. Malachi prophecy of the popes. I was very intrigued as I watched the coronation of the Pope/King standing in St. Peter's Square before the hordes and masses as he was announced and revealed. Something interesting about all of this over there in the Vatican, something that maybe you don't know. The Vatican is actually a country. Vatican City, it's actually not a city, it's a actual country. And it has its own flag. It has its own national authority. They have their own set of laws. They have their own police force, and they answer to no one but themselves.
Yeah, they're actually the smallest sovereign nation in the world. Isn't that right? 109 acres big?
Yeah, 109 acres big, and they are, roughly 1,000 people, live within the walls of the Vatican. And it's interesting because Rome, when you're in Rome, you're really in a city that has two cities. I mean, you have two parts to it. You have Rome proper. I mean, they're all part of the Italian government. But then you have the Vatican City, which is right in the heart of Rome. It has nothing to do with Italy. I mean, it's another foreign country right there smack dab in the middle of the city. And so it's a very bizarre thing. And in fact, many people don't know that that's the same way the District of Columbia is. I mean, the Washington, D.C. is set up the exact same way. It is an incorporated area that is completely has its own flag. It has its own, sets of laws, everything. And the same thing with London. The Corporation of London is the same exact way. The most wealthiest square mile on the face of the planet is the Corporation of London. All of the major financial institutions and bankings institutions are located in the Corporation of London, and they are a complete separate entity, separate from London proper, separate from England proper. So it's a very bizarre set of circumstances, and the Vatican is simply one of these. Now, what caught my attention as of late is the Vatican Bank, and I'm going to be talking a lot more about that in some upcoming articles. In fact, I've got a lot of material I've been pouring over, and I got to tell you, I could sit here and go on, and I was planning on sharing some things about the Vatican Bank on today's program, but my research is still in the early infancy stages. I was paying particular attention to what's been happening as of late with Pope Benedict as he was leaving the office and what might be the reasons for that. And then I was also paying very close attention to the Vatican Bank's new director, who is actually quite a card. I mean, so we're going to be talking a little bit more about that in the future, but I was very impressed with the whole pomp and circumstance that went on. Pope Francis, 76 years old. You know, he came in second place to Joseph Ratzinger back in 2005, right before he was actually elected pope. He's the former Archbishop of Buenos Aires. He's the first pope from the Americas, which was very big. He's the first Jesuit pope, which is very interesting. He was the first pope from outside Europe in over 1,000 years. And although he's from Argentina, he is Roman, or he is Italian by descent. His parents are Italians, and they're immigrants to Argentina or over to Latin America. He chose his royal name, Francis, based upon, there's been some speculation about this. Some believe that it's St. Francis of Assisi, which is the 13th century saint who was very well known for his humility. But there was another Francis in history that was part of the Jesuit order, and it's very possible that he was referencing him in his title. So we're kind of trying to sort all that out now. It's so brand new with the Pope just being installed into office. But you know, here's the thing about the Vatican. We got some really seriously smart people in the Vatican. I mean, these people have years and years and years of schooling. And on top of that, they have very little transparency. The Vatican Bank is completely opaque. It is a central bank similar to the Federal Reserve, not in every respect, but the Vatican Bank. If you've never studied the Vatican Bank, just do a Google search on it. You will find there are all kinds of intrigue surrounding the Vatican Bank. We're going to be talking about that in some upcoming articles. But overall, the prophecy of the popes, I found that intriguing. We're going to bring on Tom Horn and talk about that. We'll be talking more about the Catholic Church and especially the Vatican Bank in some upcoming sessions. Jennifer.
Okay, the third and final question for today comes from Stephen in Sun Valley, Idaho. Jerry, has there been any news on the Petrodollar System since your article series came out last year? And by the way, he's referencing the article series entitled Preparing for the Collapse of the Petrodollar System. And so, Jerry, has there been any updates?
Oh, well, yeah, there's always updates on this topic. And in fact, for all of our FTM insiders, I'm glad to say we have started putting up news headlines in our area where we are kind of keeping you up to date on some of the things that we're paying attention to. I do a lot of research during the week, and so I finally decided, I don't know why I didn't do this earlier, but I just said, I'm just going to put these on the FTM Insider page. So now all of our headlines that we're following that we find important, and there's some obscure sources that we pull from, we make them all available to our FTM Insiders. One of the recent headlines was all about this topic of the petrodollar system. Pakistan is in the center of it. They find themselves caught in a catch-22 because they want to maintain stable relations with the United States. Why? Well, because it's usually in your favor to be on good terms with the United States, and also the foreign aid money. Foreign aid money keeps pumping in from the United States as long as you're in their favor. So they're caught between wanting that, but also needing more energy. Their growing population desperately needs energy, and they have made an agreement with Iran to pump in through this pipeline that we talked about in the Petrodollar System article series, pump in natural gas from Iran, the Caspian Sea, and bring that down. Now, Iran's already completed their side all the way up to their border, and now Pakistan has to cough up the cash to pay for theirs. It looks like this week there was some movement on that. Iran's going to loan Pakistan about $500 million. The total cost of the rest of the pipeline is going to cost about $1.5 billion altogether. And it looks like Pakistan's going to come up with some way to pay for that. But anyway, Iran's going to start pumping gas into Pakistan. Now, the United States said, look, if you do that, we're going to place sanctions upon you. Now, remember, sanctions are an act of war. Now, the other thing to keep in mind is that Pakistan has nuclear weapons, and the United States does not have a track history or track record of going into nations that have nuclear weapons. So it's highly unlikely the United States is going to start a ground war with Pakistan because they began taking oil or natural gas from Iran. However, they're trying to apply massive pressure to them because why? Because the Iran-Pakistan pipeline is a direct competitor to the pipeline deal that the United States has been working on since the 1990s. That's the one that we talked about in the article series about how Unocal, the old oil company, was over in Afghanistan working with the Taliban, trying to get a pipeline built from Turkmenistan all the way down through Afghanistan, all the way down to Pakistan, and then finally out to India. It's called the TAPE, T-A-P-E pipeline. Well, that's the one the U.S. has been funding. That's the one that the U.S. has been protecting through its alliances in that area and through its military interventions. And now Iran and Pakistan are nearing completion on this. Looks like by the end of 2014, Iran will be pumping lots and lots of natural gas every single day down to Pakistan. So we're going to be keeping our eyes on this issue. Certainly it's causing tension between the United States and Pakistan. It's not a good thing. Also remember, Pakistan and Afghanistan, that are all over there by China, and China has been courting Afghanistan something fierce as of late. They've really been trying to get inside, and because they know when the United States leaves, there's going to be mass chaos, and China doesn't want that on their border. So China's trying to deal with it right now. So we'll see how all this is going to turn out. But yes, there have been developments on the petrodollar system. It's continuing to break down. China is no longer wanting to use dollars for its oil. It's pretty much using Russian supplies of oil and paying for them in rubles, also paying for others in gold. So we are moving away from the petrodollar system.
Jerry, I'm assuming that the reason the United States doesn't like what Pakistan is doing in the first place is because Iran won't take dollars for this natural gas that they'll be pumping through, correct? That's the whole root of the issue here.
Well, yes. I mean, that is a major part. The other part of it is that Iran sits next to the Straits of Hormuz, and that is a international choke point for much of the world's oil supply. So Iran is just this renegade nation that, you know, if you're trying to have an empire and conquer the Middle East, you've got to get rid of them, because you can't really rule that area with the psycho running, you know, Iran. So you've got to get rid of him. So that's the overall idea. Let's push him out. Let's force him out. Let's try to get him out. Let's install our own puppet dummy like we have always done throughout history, and let's get our own puppet dictator in there. And then we'll start the whole process over again, and it just never ends.
Very well. Well, if you would like Jerry to answer your question on the air, please give us a call, 800-609-5530. Press option 3 and leave your question, your name, and where you're from. Or you can send us an email, info@ftmdaily.com.
Follow the Money Weekly presents your precious metals market update. Here's Tom Cloud.
Jerry, it's been a down week in a lot of respects, but on the other, as we record this on Thursday afternoon, the dollar, after going over 83, has finally started correcting, and we've seen gold up sharply this afternoon, up to about the 1592 range. So we're still stuck in that range between 1560 and 1620, but we're a little bit on the north side of halfway, and we're just trying to hold that ground all through next week, as we've talked about many times, the 27th of March, when the debt ceiling is either raised or the government has to shut down, and we know they're not going to shut down. So things are doing pretty well. And then today, even though platinum has been flat all day, we see that Barclays came out today and sees platinum with a 251,000-ounce deficit for the year. And we're also seeing today BNP Paribas, a bank, lowering their silver prediction for this year, but they're raising their palladium and platinum forecast, which is a little bit unusual, but a lot of people keep silver and gold kind of tied together because gold has not been doing anything. They say silver. So wouldn't it be interesting if platinum and palladium were the two top metals for 2 straight years? So we are getting a lot of calls about platinum buy signal, and I guess probably more interest in palladium than anything, because we also see forecast for $1,000 an ounce by BNP Paribas for next year, which is what I've said on your show a few weeks ago. I thought it would hit 1,000 in 2014. So those people that have been holding palladium definitely should keep holding it. And the Russian situation is getting worse. They're saying they've got less than a 2.5-year stockpile. So it's kind of unique. We find ourselves talking more today about palladium and platinum, but that's kind of the way it is on my daily phone calls also. But certainly all 4 of them have a place in your portfolio, and all of them have a little different reason for moving. But in the end, I mean, gold is still the one that's money. It's still the one the central banks are buying. But it certainly could lag behind platinum and palladium and silver again this year like it did last year. So anyway, we just got to keep our eyes open, and remember next week we really got to watch, because that might be the last week to get these metals at these prices. But certainly you never can predict how the debt ceiling will play out. I'm sure they're going to try to shape it, and both parties claim a good compromise. It'll just be how they sell it and what the public believes as to how fast the metals might go up. But we all know if you raise the debt ceiling to $1.5 trillion to $2 trillion, you certainly are going to have increased metal prices somewhere behind that, and add that to the quantitative easing that's going on, and we really could have a tremendous last 2 quarters of this year, and maybe even a pretty good second quarter. So anyway, if you have any questions for me, I can be reached at 800-247-2812. That's 800-247-2812. If you don't get our email blast, you can sign up for it at ftmdaily.com and hit the precious metals button, and we keep that list completely confidential and send out 2 or 3 emails a week to try to keep you up to date on what's going on in the market, both economically and with the metals. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years' experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly, and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly, and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Jay Peroni, Certified Financial Planner, here with the idea of the week. This week we'll take a look at 2 of my favorite all-weather sectors. Since 2009, the all-weather portfolio has been a consistent strategy in both good and bad markets. It combines high-quality, low-volatility stocks with other asset classes like precious metals, commodities, bonds, currencies, and hedging vehicles. I look for investments that can do well in any type of market. These types of investments are what I call all-weather investments because they can do well come rain or shine. 2 of my favorite sectors that are needed no matter what the economy are doing is water and healthcare. Over the next decade or 2, we could see a global water crisis. Access to healthy water is one of the most severe problems facing our world today. So how do you invest in water? Unlike other commodities, water is not traded on the major markets. Instead, investors looking to play on the growing demand for clean, portable water must look into ETFs and water utility stocks as a way to invest in the commodity. Most of these companies pay strong dividends of 2% and above and have great potential for long-term capital appreciation. Looking through the water investment choices takes some time and effort. My favorite stock to capitalize on the need for water right now is Aqua America, ticker symbol WTR. Aqua America is a public water utility. The company operates as a holding company for regulated utilities that provide water or wastewater services in the United States. It serves residential, commercial, fire protection, industrial, and other water and wastewater customers in 13 states. Its history dates all the way back to January 4th of 1886 when a group of college professors were granted a charter to supply water to the residents of Springfield Township in Delaware County, Pennsylvania. Aqua America, ticker symbol WTR, is a good buy up to $33 per share. My goal is a 15 to 20% gain over the next 12 to 18 months. It pays a 2.25% dividend and has raised its dividend every year since 1992. One of my other favorite sectors is healthcare. I also love real estate. Some investors like the diversification and potential of real estate investment trusts or REITs, and healthcare investment trusts are a niche within the REIT sector. A healthcare REIT invests in properties like healthcare facilities, medical office buildings, retirement and nursing homes. With a healthcare REIT, you can invest in prime commercial real estate that is already professionally managed. With the aging population, demand is increasing for healthcare and long-term care facilities to be built and leased. That's why many investors feel like healthcare REITs will perform well regardless of what Wall Street does. Additionally, hospitals and healthcare providers constantly need capital. Investors profit from healthcare REITs in the same way they do with all REITs, through dividends and long-term capital appreciation. My favorite healthcare REIT right now is HCP Incorporated, ticker symbol HCP. Healthcare Property Investors is a real estate investment trust. The company invests in healthcare-related real estate located throughout the United States. Its assets include long-term care facilities, congregate care and assisted living facilities, acute care and rehabilitation hospitals, medical office buildings, physician group practice clinics, and psychiatric facilities. HCP Incorporated is a good buy up to $51 per share. My price target is a 20 to 30% gain over the next 12 to 18 months. This pays a 4.13% dividend, and it has raised dividends every year since 1986. So those are two stocks worth a closer look: Aqua America, ticker symbol WTR, and HCP Incorporated, ticker symbol HCP. This is Jay Peroni, Certified Financial Planner, signing off for this week's Idea of the Week. We'll see you again next week.
All right. Well, Jay Peroni is a CFP Certified Financial Planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a free 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
Are you tired of getting whiplash from the stock market? Is the return of your money more important than getting a return on your money? In these difficult economic times, it's only natural to seek out wise investing counsel. Thanks to a new service called the All-Weather Portfolio Strategy, you'll get real-time access to our service, which only invests in high-quality companies with historically low volatility. Have you ever been caught in the rain without an umbrella, or left the house without sunscreen on a hot and humid day? Sometimes the weather catches us by surprise. Just like the weather, the investment markets can also catch us by surprise, and sometimes without warning. There are times when the markets soar and we miss out on gains, or maybe we have too much in the market and suffer a major decline during volatile times. That's why we created the All-Weather Portfolio Strategy. The All-Weather Portfolio is suitable for cautious investors, those with a time horizon of 5 to 7 years, those who are close to or in retirement. The goal of the All-Weather Portfolio is to protect against losses in a down market while still taking advantage of the markets when they rise. With the All-Weather Portfolio service, you'll get 24 hours, 7-day-a-week real-time access to the portfolio. You receive instant buy and sell alerts directly in your email inbox. You'll also get a special 27-page report entitled An Introduction to High-Quality, Low-Volatility Investing, a $47 value. To learn more about the All-Weather Portfolio, go to wallstreetrenegade.com/all-weather. Again, that's wallstreetrenegade.com/all-weather.
All right, where's my money? Money. Daily bread.
Follow the Money Weekly presents the Retirement Minute.
Today I would like to talk about a situation that is of very real concern to parents with small children. Here is the situation. How can we possibly save for retirement and our child's college education at the same time? It's seldom easy to achieve a balance between savings for your retirement and saving for the ever-increasing cost of college education within your present income. Yet it's imperative that you save for both at the same time. To postpone saving for your retirement means missing out on years of tax-deferred growth and playing a near impossible game of catch-up. To accomplish both goals, you may need to compromise. The first step is to thoroughly examine your funding needs for both college and retirement. On the retirement side, remember to include the estimated value of any employer pension plans as well as your Social Security benefits. This evaluation will likely prompt you to examine some deeply held beliefs about your financial goals. For example, is it important that you travel regularly in retirement? Or is it more important that your child attend a prestigious Ivy League college? If you discover that you can't afford to save for both goals, the second step is to consider some compromises, like deferring your retirement and working longer, reducing your standard of living now or in retirement. Increase the family income by seeking a better paying position in your present career, getting a second job, or having a previously stay-at-home spouse join the workforce. Beware, though, of potential drawbacks like daycare costs, commuting costs, and tax disadvantages on the increased income. Seek out more aggressive investments, but beware of the risk. Expect your child to contribute more money to college. Some parents may find it difficult to accept, but the majority of college students finance a portion of their education with student loans. Investigate less expensive colleges. You may find that some less expensive state universities have more to offer in certain programs than their pricey private counterparts. The third step is to reevaluate your plan from time to time as your circumstances and wishes change. Remember, the important thing is to earmark a portion of your present income for both goals and do the best you can. So make sure you have your financial affairs in order, and a good way to start this process would be to contact me through the Christian Financial Advisors Network by email at John, that's John, at cfanetwork.org. Or you can call me toll-free at 888-914-9909. I would be more than happy to review your financial situation with you to make sure your financial house is in order. And thank you for joining me this week for your Retirement Minute.
All right, friends. Well, that brings us to the end of our program. Thank you so much for choosing to allow me into your life each and every week. It is an honor and a privilege to be a part of yours as well. And as always, I leave you with this final word, this time spoken by the very wise King Solomon in Proverbs 22, verse 1, when he said, "A good name is to be chosen rather than great riches, and favor is better than silver and gold." Just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTMDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.